So when talking with your CPA or advisor, you may have heard the term Roth Conversion. But what does this actually mean? What are the benefits, and is it something you should consider? So a Roth conversion is just the process of converting a traditional IRA, or commonly referred to as just an IRA, to a Roth IRA. So if you don't remember the difference between those two, a traditional IRA is a retirement account where you get a tax deduction for whatever you contribute, up to the annual limit. But then at retirement, when you withdraw from that account, all the contributions and the earnings on those contributions are taxed. A Roth IRA is the opposite. So you don't get a tax deduction for contributing to that retirement account. However, when you withdraw it at retirement, all the contributions and all the earnings on those contributions are tax-free. So huge tax benefit. So the philosophy behind a Roth conversion is that you can take money that's sitting in a traditional IRA, remember money that has not been taxed yet, and decide to pay taxes on that today. But then you're done paying taxes, so it can continue to grow and be withdrawn tax-free at retirement. You're paying taxes today instead of later. So when would this be beneficial? Well, if you expect your tax rate to be higher down the road when you retire than it is today, converting today may be advantageous. For instance, let's say I'm in the 22% tax bracket today, but due to expected income in the future and tax rate changes, I expect to be in the 32% tax bracket when I retire, when I start withdrawing from these accounts. Well, it's better for me to pay the taxes now, today, at a lower 22% tax rate than down the road when not only is the account going to be hopefully of greater value, but I'm also going to have to pay higher taxes on that at a 32% tax rate. It's similar to good nutrition in exercise in that you're paying a smaller price today to avoid a bigger cost down the road. And the reason this has been getting so much attention lately is because we're in a historically low tax rate environment. And with the mounting US debt, the cost of these stimulus packages, it's very likely that in 20 to 30 years, maybe even as little as 5 to 10 years, tax rates are going to be higher than they are today. And if that's the case, we can pay lower taxes today on these retirement accounts than higher taxes later on. But a few things to consider before doing this. So number one, you will have to pay taxes on it today, meaning your tax bill may be substantially higher than what you're used to, depending on how much you convert. And number two, you need to be careful about pushing yourself up into a higher tax bracket. So anything that you convert, that's going to get added to your income, which you're going to have to report on your tax return. So you may want to, depending on how much you convert, spread this out over a number of years to avoid pushing yourself up into another tax bracket and therefore diminishing the benefits of actually doing this in the first place. This is the reason why it's really important to have a CPA walk alongside you during this process. They can figure out what works for you. And then there is the risk that tax rates are actually lower in the future. I think the likelihood of that is low, but it's a risk nonetheless. Now, none of this is intended to be tax advice in any way. I highly recommend that you engage a CPA to help you with this. Depending on your situation, with proper planning, this could potentially save you tens of thousands of dollars. But again, that has to be done with proper guidance and planning, and the cost of hiring a CPA to help you with something like this is a fraction of what you could save with proper planning. So it's absolutely worth it. There are some Roth conversion calculators out there, but again, I really think it's worth it to partner up with a professional on this. Hope this was informative and helpful. Have a great week.